Hi everyone, thanks for checking out my channel. I'm going to have a look today at natural gas market, what's gonna be ahead of us and what kind of trading plan we can set trying to benefit from it. As I've done it I think 2 weeks ago, I'm gonna run through the bullish and bearish arguments and see if we can actually get out of this some sort of a trend that it's probably more likely to actually happen, at least for the short term. So let's get started with the bullish arguments. So the first one is we got low injection last week at 45 versus 60 as an average at that time of the year, so that's rather positive. Of course it's down 15, which is comparing to the overall storage insignificant, but psychologically we can say that it's definitely supporting the price and at least avoiding for the price to go much lower. Supporting holds the price and it's reflected in that low injection, saying is the hot weather that is forecasted for July. It's gonna be cooling off a little bit second half in the current forecast, but still looking very hot and above average, so that's definitely supporting the demand. As we could see, the power burn is running very high at the moment, so that's explaining also why the injection has been relatively low. The demand, of course, on that side is improving. We're sitting at 89 at the moment BCF per day, which is still lower than the usual at that time. It should be above 90, 94, 95, lower, but not extremely lower, so we can also supporting the price. In the same area about production, we can see the stable rig counts. It doesn't actually increase, they're sitting at record low. This could be somehow seen as bearish as well, because the number of rigs is extremely unlikely to go much lower, so potentially the production can only go up from here. But I've said in the past that the rig count is not enough to actually assess what the production is doing. They put off many of the underperforming rigs and all the best performance in order to reduce operating cost have been actually ramped up. So this is why the production didn't collapse and only reduced a little bit, and not actually in the same proportion that we had the number of rigs down. So little bit careful with that argument with the number of rigs, but still sitting low and not increasing is somehow bullish for in the short term at least. Now looking at the quote report, I don't have it here on the screen, but managed money increased a long position, so that's of course bullish. They're still sitting slightly net long, which is positive in a way, but could have also a downside should they actually start loading shorts, because they could, and then of course the price will have a long way down because they are sitting at a relatively high compared to the maximum short position they can hold. So a bit of a risk here. Also, I believe that now we are ahead of winter. It is probably unlikely they're going to get major exposure on the short side until they can get some clearer view about what the weather might be during winter, before they would actually allocate more to the short side or the long side. So probably rather bullish for now. Also it could turn bearish very soon, very quickly. Also quite bullish open interest. Previous week was down 30k, which is actually a bullish thing because we had mainly a move down from that top at 187 down to 172 during that time. So we got a falling open interest that is not supporting the strength of the move, so that's definitely bullish. And finally, in terms of the technicals, we had that 4 hours divergence here. Display down, it's a bit clearer that way. So here on that point at 188.91, we got that divergence here. So we reporting down to the first leg of the divergence, down to 171, and last week we did actually made a touch on the 14, but broke lower here. So we can say that this is pretty much cleared up, and that divergence is unlikely now to actually play any longer. Of course, the momentum is there. You can see there's no reduction in there. We're still moving down inside that channel, so that divergence is over. But as we can see on the 4 hours, we didn't set a bullish divergence on the way down, and that last move down to just slightly below 170 is still sitting with a lower low on the RSI, so we don't have any reversal sign yet, and anything that could actually point for a short-term reversal that could actually break higher outside of that channel. But I'll get back to this on the bearish side, because that's of course where it will actually stand. Now, looking at the bearish arguments, there's quite a few, and in my opinion they are more predominant over the bullish ones. I think the bullish arguments mainly are actually pointing to a longer term switch, as we are going to see some speculation and a bullish rally on natural gas ahead of winter. It's almost certain. The only issue is to get the right timing, to get in and avoid losing the performance of the trade with contango and potentially the price staying much lower than what we would have expected. So the timing will be critical to open long, and I highly don't recommend to open long yet. This is too early, other than for short-term trade, but hold and buy and hold on natural gas has been proven to be extremely risky, and I think even now, mid-July, it is still too early in my opinion. So let's have a look at the bearish arguments. Of course, we got hot weather for July, but major exposure for weather change. Understanding that with global warming, temperature moving up from one year to the other, the summer getting hot is unlikely to get much cooler, so the risk is probably less than in winter when we get actually polar vortex cancelled or that kind of thing. So don't expect major move in that area, but should we see some cooling off on the weather side, and then we could actually quickly drop as well, just because the expectation is not going to be there anymore. So careful with this. Of course, the LNG market is in crisis. Exports still at record low, no sign of improvement. The Europe storage is running on 82% capacity, so it's forecasted to actually reach full capacity now in October, and we will be at record storage in the US at that time. So entering winter in a very bad position, even worse than last year. So we will need a very cold winter, very high demand to actually get a proper reversal. I believe the downtrend is here to last for quite a long time, and the storage is definitely going to be a continuous issue until we have a major switch on this market. Also on the bearish side, we can see that the production are starting to ramp up despite the stable number of rigs. They have actually managed to increase slightly from 87 to 88 now in July in 1 month, so it's not much, still below the 95 we had earlier this year, but this is pointing to the end of the production cut and potentially linked to WTI production resuming. I'm gonna do an analysis on WTI later on as well, explaining that producer will have to actually increase production on WTI for debt payment reasons. They won't be able to actually keep producing low, even the price is still actually sitting relatively low. So this is definitely not helping. We're going to see production ramping up, I believe, and natural gas indirectly, but directly also with natural gas producer facing the same sort of issues the oil producer are facing. Looking at the quotes reports, we've seen as I say, that the open interest reduced previous week, but on the last few days, so zooming to that part of the chart here, we have seen quite neutral on Thursday. So we had that really big sell-off from 180 down to 172, so it's not really solid open interest increasing, but we have quite a significant increase on Friday, which is not a good sign, as we got some bounce back and then a sell-off followed to actually close lower, and then it did happen with the plus 6k open interest, so definitely negative. We'll see how we go next week, but very likely to continue on the same trend. Looking at the spread also on the future contracts, we can see the spread is now increasing again. August and September is now near 3%, and I believe September, October is now back near 6% or even maybe above. Of course, that's gonna play against the long position again. We're going to roll over. Should we roll over from that point, not too far away, and not actually crash down too quickly? We are going to have a gap up again between the two contracts, potentially from here. Should we open the gap up, we are going to open near the upper trend line of the channel, and again the long position will get squeezed out and feed the continuation of the move down to close the gap. So again, it could happen the same way that did happen the months before. So that was it. I can just zoom on that one here. On that area here, we could see what happened. I'll change the color for this. Here, so basically we got the gap moving from 167 up to 177. So it's about 5% up. So we're gonna get less that time, I believe, except if we got a really big drop next week on the price. And then we got all the way down to clear the gap and even push the price further down. So that was quite bad for long position again, and I believe we could see a similar scenario this month, potentially reaching again to 1.5, which is my final target for that swing. So yes, that's definitely a negative. As I say, for quite a while now, we're having the 174 gap still open. Gonna draw it once again, but it's quite obvious. We don't see how we're going to avoid closing it from here, but definitely that will actually point to the price trying to actually close it before we actually get into winter. That being said, we can also see on the 4 hours chart that's massive head and shoulder setup. We could consider one shoulder, the head here, the shoulder there, that did start actually pushing on the limit. If we take technically some targets for this, we take the head and we just report it lower. That will basically take us to 150 as well. So again, pointing to continuation of the move down. Yeah, not helping either. We're having strong resistance just above. There's one first trend line that's running now here. It's a very short term at 175. But more important, if we zoom out on the daily, we have that massive trend line here, highlighting there. I just changed the color to make it a bit clearer. What about blue? No. Yeah, let's make it purple and a bit bigger. So that one is running here from that point to here. So running from the 290, which was the high of last winter, putting on 2.1 and recently on 1.9. That's going to be massive resistance, very unlikely to break until we get some clear momentum back up, and I believe we need to clear up much lower to actually be able to do this. That will definitely work against the price breaking much higher, and that's kind of a safety net for short position above 1.8, as I don't believe the price will be able to sustain any higher than at least 1.85, at least in the short term. So yes, that's balancing pro and cons for taking long or short position. In my opinion, it's almost a no-brainer. I'm gonna stick to the short on that market until we actually get to the target, which is 1.5 unchanged. We potentially could move a little bit around 170 next week. Let's change that one here. Yep. Before resuming move down, 160 will be some support. I could potentially clear the trade here, reload on the trend line, and look at going further down to 150. So that will be my plan. I'm already holding short positions that I did accumulate from I think I have a few that I did start building on 185, and I did add to this on the 180 break. So it's It's not a trade for now, it's in profit. I will let it run until the objective is achieved. So we see some massive reversal signals, bullish signals here on 1.6, might actually exit there, but we'll reconsider depending how we go. No, that's for the short term. Now looking at the longer term plane, definitely looking to play the next rally up that we're gonna get on natural gas very likely. And I will accumulate long on daily divergence on the 1.5 rejection. If we look at what happened here, the last rally we had, just like this, yep. So that rally we got to 2.1 came here after we set quite a significant divergence on that move. We got the clear move down here, and we did set from that point here a clear divergence moving up. So my plan, should we start seeing that kind of divergence showing here around 1.5, would be to start accumulating on each touch on the trend line, because this is highly rewarding. Ahead of winter we'll be unable to probably break much lower. We're gonna get 1.4, it's gonna be the floor I believe, and from there of course the potential up is massive and much higher than the downside potential. So, and the weather in support will definitely help with that, so that will be the plan longer term, but this is I believe too early. If we look at the weekly bullish divergence we're having in place, I'm still keeping an eye on this because this is important. Let's get rid of this. So that's the trend line on the RSI that I'm actually looking at. We're having definitely a bit of room to move down. 1.5 could actually make it for a new touch on the weekly divergence trend line. That could be one entry point should this hold. Of course, timing entry on the weekly RSI is a little bit difficult on the weekly chart, so we'll have to zoom in and check what's the daily is showing. Should we see the same divergence on the daily, that will be a clear buy signal, and at least starting to accumulate long and of course stop shorting the market. So yeah, that's the plan. Gonna have a look at this in the coming weeks. Of course, I believe early August, potentially mid-August, might start to see some interesting signal to buy natural gas, but for now I think the long position are still a little bit too early, and shorting the market on any spike is still the most profitable strategy. And yes, I hope you enjoyed the video. Wish you safe trading, and I speak to you soon. Cheers, bye.